Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. Today we're taking a look at three highly ranked dividend stocks to consider buying in February for safety throughout the rest of the next few months and maybe the rest of 2022. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these three stocks today, it's worth diving into where we are in the market at the moment to give context on why you might want to consider these three dividend-paying stocks. So luckily, the last few days of trading in January provided a much-needed rebound after a brutal month for stocks, with the S&P 500 suffering its worst month since March of 2020, even with that bounce back. So some bullish optimism returned. Since then, Wall Street was clearly deciding it was time to start buying some of the beaten down stocks that had seen large chunks of their pandemic gains washed away and valuations recalibrated closer to pre-COVID levels. We also saw the strength of big tech giants like Apple, Microsoft, and Amazon, even while Netflix, PayPal, and others tumbled pretty crazy sessions. So overall, the Nasdaq's down roughly 12% from its highs and about 10% on the year. This has improved from being down about 17% before that bounce back, with the S&P 500 back above its 200-day moving average and down only around 5% in 2022. So the market could clearly experience more selling and certainly increased volatility in the coming weeks and months, considering the lingering COVID impacts, rising inflation, and the increased likelihood of Fed rate hikes, which tie directly into that. We also saw the 10-year U.S. Treasury, with that in mind, touch 1.97% today, so nearly 2% today the last time I checked. So staying on the sidelines clearly is a possibility amid these bouts of heightened uncertainty, and keeping cash on hand to invest after big downturns is crucial, which we've already seen many on Wall Street doing recently. Also, trying to call a bottom is extremely difficult and often really only done precisely in retrospect. Let's also remember that interest rates will have to climb a lot higher to make equities broadly unappealing. Plus, the outlook for S&P 500 margins, sales, and earnings are still really resilient and historically strong for 2022 and 2023, despite all of the negatives and the somewhat downtrodden headlines. This means that investors, especially those with longer-term horizons, might want to consider buying stocks. And with this in mind, we're focusing directly on dividend-paying stocks that are not super bloated at the moment in terms of valuation as well, to give us some income amid what could be a more choppy year after 3 huge years of outsized market growth going forward in 2022. So the first stock we're taking a look at today is Public Storage, which trades under the ticker PSA. Public Storage is a REIT that primarily acquires, develops, and owns and operates self-storage facilities. It has over 2,600 facilities across roughly 40 U.S. states and serves more than 1 million customers. Public storage has been gaining momentum for years as Americans continue to buy more and more things. It's really simple as that, from furniture to electronics. And many of these things end up in self-storage units, which are essentially giant walk-in lockers or closets, whatever you want to call it, that are rented sometimes on a monthly basis or longer. Public storage in the broader industry have customers who include everyone from college students to people who live in apartments and condos in big cities, to those who have huge homes with basements, and a variety of really other clients. The self-storage industry was growing long before the pandemic, and then COVID then sent the self-storage sector flying as Americans reworked their entire lives. This saw people kind of move in mass, buy second homes, purchase big-ticket items, clear out garages, spare rooms. Even businesses utilize storage to keep extra inventory and other essentials. All of this helped the industry and allowed them to raise prices. Public storage and the other players now have greater pricing power, and crucially, many of its customers will end up holding onto their units for a long time for various reasons. One of which is that it's hard for many people to part from items, even if they've been sitting in storage for a long time. I'm sure most people know at least someone in their family who never wants to throw away anything or donate it or give it away. It's really just worth stressing again and again. I mean, anywhere you live, you've probably seen countless self-storage units whenever you're driving anywhere. It's worth stressing just how much stuff the average person or family has. With this in mind, the company has been growing steadily for years and years, and PSA is set to release its fourth quarter fiscal 2021 results after the market closes on Tuesday, February 22nd. So before we look ahead to what we're expecting, it's worth noting that instead of earnings, REITs report funds from operation, or FFO, but investors can really view them as essentially the same thing. So with this in mind, the company's adjusted FFO is expected to climb over 17% in the fourth quarter to $3.44 a share, with its revenue set to climb 22% overall. It's expected to see its revenue climb 18% this year to $3.4 billion, and its adjusted FFO climb 21%, with then another 13% bottom line growth next year and another 10% top line growth. We should also note that the company's longer-term earnings estimate revisions, so this is for 2021, 2022, and 2023, have continued to climb really significantly over the last year and a half for kind of all the reasons I just mentioned. And it's currently a Zacks ranked number 2 buy with some positive earnings estimate revisions activity. PSA shares are up 55% in the last year to blow away its industry's 15% climb, and they're up 165% in the past 10 years. This is versus 63% for its industry, and this includes a stretch of sideways movement for a few years before COVID, so it's really bounced off those COVID lows. The stock is trading near its highs at around $364 a share, but it trades 13% below its year-long high in terms of forward earnings at 24.8 times, which is also not too far above its decade-long median of 21 times. This is despite climbing over that decade. And we should also note that it's trading far below its current consensus price target of $420 a share at as we said, $364 a share at the moment, and its 2.2% dividend yield tops the 10-year U.S. Treasury, the recently rising 10-year U.S. Treasury, the S&P 500 average, and is roughly in line with the 30-year U.S. Treasury. So PSA is certainly worth considering at the moment as a longer-term play within the growing self-storage industry that's certainly not going to go out of style anytime soon, and it also pays a dividend, and its valuation is hardly bloated considering what it's done in the last year. So now we're going to move on to a totally different industry and a much likely more well-known company, that is Texas Instruments, which trades in the ticker TXN. Texas Instruments makes analog and embedded semiconductors that are utilized within the automotive and industrial sectors, as well as consumer electronics, communication equipment, and elsewhere. TI is maybe most well known for its calculators. I know I used them in high school, with some people obviously knowing them, as I said, for those calculators, but it's a big chip business, and it's still important even with its analog chips in our digital world. Its analog chips treat incoming information about everything from temperature and sound and electrical current more like a human would, which is on scales compared to our digital chips. Texas Instruments has been around for about 90 years, and it's coming off a strong fourth quarter on January 25th amid a large-scale chip shortage. Its quarterly revenue climbed 19%, quote, driven by strong demand in industrial and automotive markets. Its analog revenue was up 20%, and embedded processing grew 6% from the year-ago quarter. Overall, its 2021 revenue was up 27%. This came on top of about 1% growth last year, and his adjusted earnings climbed 40%. Looking ahead, we're calling for another 9% growth on the top line this year to about $20 billion for Texas Instruments, and then 4% growth after that. And then we're calling for another 10% growth on the bottom line this year, and then another roughly 4% bottom line growth in 2023. And the company has pretty consistently and sometimes pretty hugely beaten our bottom line estimates, including a 16% beat last quarter. We should also note that the company's FY 2022 and FY 2023 consensus earnings estimates have trended heavily upwards since its report, with 2022 up 11% in 2023, up 10%. This helps it grab its Zacks rank number one, a strong buy at the moment. The company is also very committed to returning value to shareholders. In fact, the first thing you see on their IR page, their investor relations page, is a quote from their CEO saying, quote, "The best measure to judge a company's performance over time is growth of free cash flow per share, and we believe that's what drives long-term value to our owners." So Texas Instruments still a stock within a strong industry, chips, semiconductors, but unlike some of the really growth-focused names, it's really committed to returning value to shareholders through dividends and buybacks. Last year, it returned $4.4 billion to shareholders. And for the year, the dividend represented 62% of free cash flow. So that underscores that it's really sustainable going forward. Overall, in 2021, it raised its quarterly dividend by 13%. This was the 18th straight year of a dividend raise. Since 2004, its dividend has grown at a compound annual growth rate of 25%. We should note that its current dividend yield is at 2.7%, which crushes its industry's 0.5% average, well above the S&P 500 and above the 10-year and 30-year U.S. Treasury. And this is all considering the fact that the stock is up 420% over the last decade, which does slightly lag its broader semiconductor industry's 500% climb, but a lot of that outperformance from the industry compared to Texas Instruments has been within the last year. With the stock roughly flat, it's down about 1% over the last 12 months compared to its industry's 27% climb. So with that said, it's trading at around $174 a share, which is 15% below its highs and around 18% beneath our current Zacks consensus price target. It also trades below neutral RSI levels at the moment at 41, so it could have plenty of more room left to grow. And it's trading at 3-year lows, roughly the same level as during the bottom of the COVID sell-off at 18.6 times forward 12-month earnings, which also marks a 32% discount to its industry's average. And it's a discount to its decade-long median of 20 times forward earnings. So really solid valuation for Texas Instruments overall. And it's part of a industry that sits in the top 13% of over 250 Zacks industries, and it's a strong buy. Zacks ranked number strong buy at the moment, So it's definitely worth considering Texas Instruments as a play on the chip space for growth, and it's not going out of style, even though it's not the big growth name, but it also is a dividend payer. In finding strong dividend paying tech stocks that have seen their stock price soar over the last decade that also are trading at a solid valuation is not super easy to find. So Texas Instruments certainly worth considering at the moment. And now we're going to end with a company that had struggled for a long period of time, and it's part of an industry that had struggled for most of the last decade of the 2010s. That is ExxonMobil, which trades in the ticker XOM. Its Q4 earnings beat our Q4 earnings and revenue estimates on February 1st. So overall, ExxonMobil is a oil and gas behemoth that operates a well-rounded industry portfolio. And it's benefited from rising oil prices and a huge rebound in energy demand as the global economy continues to bounce back. The company in early December said it projects to double its earnings over the next 6 years compared to its 2019 levels. The company, like most of the industry, is also slowing capital spending amid rebounding demand instead of blowing out spending to ramp up production, which is good news for investors. Still, the company will spend between 20 to 25 billion a year on capital investments through 2027, which is 17 to 33% decrease from its pre-pandemic projections. Even though it's focused on cost cutting and other measures, Exxon has said it's focused on enhancing its low carbon business, which could be important going forward. This is part of a broader effort to lower global emissions. Exxon reported $23 billion in profit for 2021, which was its highest total since 2014. This includes $8.9 billion in profit in the fourth quarter. The company also generated $48 billion of cash flow from operating activities, which is the highest level since 2012. So really blowout blockbuster year for Exxon and a lot of the other oil companies. And they said that, quote, more than covered its capital investments, debt reduction, and dividend plans. Going forward, the company also, its CEO said that our effective pandemic response, focus, investment during the down cycle, and structural cost savings position us to realize the full benefit of the market recovery last year. So yeah, came off a really important year for the company, and it could maybe spark positive things going forward after what was a tumultuous period for the broader energy sector and certainly these big oil companies. With this in mind, Exxon's 2021 revenue soared 57%, with 2022 projected to come another 8% higher to $308 billion, which would easily top its pre-COVID totals in 2019 and 2018. The company also swung from an adjusted loss of 33 cents per share in 2020 to positive $5.38 per share in 2021, and it's expected to follow this up with another 30% stronger earnings in 2022. And the company's 2022 and 2023 consensus earnings estimates have really climbed since their last report, with the consensus estimates up 19% for 2022 and 14% for 2023 over the last 60 days. This helps it grab a Zacks rank number 1 strong buy at the moment. It also lands an overall A VGM grade with an A grade for growth and B for momentum. And the oil and gas industry that's a part of is in the top 4% of over 250 Zacks industries. So overall, its shares have surged 60% in the last year versus industry's 54% climb, and the S&P 500's 15% climb. And the rotation out of tech into other areas such as energy and cyclical areas has been really pronounced in 2022. Exxon is up 33% this year so far versus the S&P 500's roughly 6% downturn. And at around $80 per share, Exxon is trading near its 52-week highs, but it still has room to run before it returns to its 2014 levels. On top of that, its recent outperformance, its 4.4% dividend yield provides investors with really solid income. It tops its industry's 3.3% yield average and blows away both the 10-year and 30-year U.S. Treasury. Despite this run, Exxon is also trading 7% below its year-long median at 11.9 times forward 12-month earnings, and this is 55% below its year-long highs. This also represents a solid discount to where it was trading for several years leading up to the pandemic. It was trading near the end of 2019 at about 21 times forward 12-month earnings, and as I said, now it's trading at 11.9 times forward 12-month earnings, so that's a really solid valuation also for ExxonMobil. We should note that the stock did fall on Tuesday, and there could be some more near-term selling with it slightly above overbought RSI territory, but overall, we could look for maybe the energy sector to have a continued bounce back after tech has just dominated and growth names have dominated so far the last several years. And if 2022, the beginning of 2022, is any indication of the rest of the year, we could see maybe these cyclical names like energy continue to be strong. And once again, it's a Zacks rank number 1 strong buy. It has a really solid dividend yield, and its valuation is solid, like all 3 of the stocks we talked about so far today. And that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.